Morning. How's everybody? Who flew in here from someplace with horrible, dismal, nasty weather? Anybody? All right, good, so welcome. My name is Greg Rand. I'm really excited and honored to be able to take this position to moderate. Dennis Stern, I don't know if he's in the room or not, but Dennis did this for many years and did a great job and passed the baton, kind enough to give somebody else a shot at it. We'll see if it goes beyond one session here, but to set the tone for the panel this morning, I just wanted to make the point, I think, that it's really early in this SFR space. You know, this is an asset class that has been around since the Pilgrims landed, and yet it took until the housing crisis 10 years ago before it got professionalized and institutionalized, and now that's accruing to the benefit of small investors, mid-sized investors, and of course professional investors alike. And so it's exciting, and I look around and, you know, there are, on our panel here we have a couple of lenders, we have analysts, we have marketplace platforms, but I consider all of us to be brothers and sisters in this. You know, we're competitors technically on some days, but we've got ourselves something here that's like bigger than mobile phones. It's an asset class, it's a business that is so big and so underserved that you know, if we all play our hands halfway well, we're going to do very well. So welcome, thanks for being here. Thank you to IMN. This conference has become kind of the every 6-month benchmark of what's happening in the industry. I love the fact they do it every 6 months. I love the fact that Scottsdale and Miami Beach have become part of my life now, which is cool. And so, great panel. Let me just throw it over to them. I asked everybody in the advanced conversations that we had to prepare a couple of remarks here and there, and we'll start with the introductions. And what I asked you to do when you do your introduction is to tell us the thing that happened in 2018 that was the most impactful, interesting, compelling, scary, surprising, whatever. But just one thing that happened in 2018 that you know, you can make thought-provoking and share with the audience. So we'll start with Sean. Introduce yourself.
Good morning, I'm Sean Miller. Not a very far trip for us. We live in Southern California. We are a lender in the space. I'll go just briefly over this past year. A couple things I think that were exciting, which I think is consistent with Greg's comments about this being a relatively new industry. People like Beth here and myself, who've known each other a very long time, have been around the capital markets now on and off for about 20 years. And one thing that's really unique is generally institutional, 30, 25. One thing that's really interesting is that institutional capital on the debt side in particular tends to trail a lot of sectors because people like Beth and some others first have to sort of knock down some doors to convince institutions that in fact this is a credible and scalable business. So we started raising capital about 5.5, 6 years ago in this space, first in fix and flip and then in SFR rentals. With the sort of construct of what's happened in the secondary market, securitizations this year in fix and flip, securitizations in SFR over the past year and a half, Freddie and Fannie to some degree or another getting involved. What you're really noticing is there's a maturation of the space. 2018 to me would be the reflection of a space and an asset class that now is sort of on the radar. But I really think, to Greg's point, it'll be interesting to hear from the other panelists, I think we haven't touched the surface. So when we talk about what we may think about in 2019, I'll give you a couple of ideas that we think about. But for 2018, I think it really is a matter of putting your tool belt on, putting the tools into the tool belt, and beginning to really walk down a path of financing, building, and managing large-scale SFR. We'll get into the economics of why we think that, but if you've noticed, most of us now have partnered in one form or another with institutional, public and private capital. By definition, that means, and sometimes it's difficult to understand, but that really means that's an infinite amount of capital. It means that this business of SFR is going to be as big as all of us can make it. There is so much, the vernacular is dry powder, there's so much dry powder waiting to get into yielding industries like this, that it's incumbent upon all of us panelists and everyone out there to really demonstrate the ability of scaling. So to us, it was the year of maturation. I really do appreciate being here, and I'll turn it over and we'll start talking.
Beth?
Yeah, hi, I'm Beth O'Brien, the CEO of CoreVest, which was started almost exactly 5 years ago, as Sean mentioned. And although I was in the fix and flip market for several years even before that, I think there's really two words that I would describe 2018, and that is liquidity and standardization for the debt market. And I think it really feeds into what Sean was talking about, maturation. Very much driven, I think, even by the GSEs coming in and out. I think everyone, I mean, it was definitely the news of 2018 that, you know, Freddie was in, Freddie was out, Fannie was in, Fannie was out. But I think it had a really positive effect on the market. And I think part of one of the public statements that the FHFA made when they were deciding to stop the pilots was that they thought the private markets had actually matured to a point where it was serving the need that was necessary. But by having them come in, first by wrapping a few bonds, both on the institutional side and on the conduit side with one of ours, they were able to say, look, this is an asset class that is mission critical, that is part of the structural housing stock in the United States. And we are willing to support it, or at least we're willing to do the research to figure out how best to support this part of the market. And I do think it's neither commercial nor residential, that it does require bespoke products. And I think that really put the standardization piece on it that was necessary so that you could drive liquidity in the market. And I think most people have seen spreads have tightened this year. The debt is becoming more and more affordable for people, so that as, you know, even as the base rates are rising, because the spreads are coming in, the numbers have stayed about the same. And you're seeing a huge influx of new products. All of a sudden, build to rent is something that's easily financeable. All of a sudden, the construction pieces are actually happening again. And so you're really seeing you're seeing the market, I wouldn't say explode, but really starting to burgeon at the edges. And I do credit the entrance of the GSEs and the orderly exit, the way that they were able to exit in a positive fashion, as part of what has created both that standardization and the increased liquidity.
Good morning, everyone. I'm John Livanski. I lead Green Street Advisors' residential research function. Green Street Advisors is probably best known for the 30 years it's been around for our work on REIT valuation and our stock picking track record. So essentially, a lot of our day-to-day is spent telling active money managers which stocks, real estate REIT stocks, and which sectors look cheap or perhaps overpriced. We also have a private market team who tries to answer the question, if you're buying physical real estate, here are the property types that look interesting to us, and here are the markets across the country that look interesting to us. But as it relates to single-family rentals, I would say the biggest surprise from our lens in 2018 was for all the things that the sector has going for it, which you'll hear on this panel and probably throughout the course of this conference, the single-family rental REITs, the two big ones, have underperformed every other REIT sector 2018 year to date. If you sat me down January 1st and told me I could buy one sector and job growth is going to be over 200,000 jobs per month, home ownership and single family construction is not going to really go anywhere, demographics are only improving, and oh, by the way, disruptors in other sectors like Amazon with retail, WeWork with office, apartment REITs are going to get a scare with Costa-Hawkins rent control risk. That's going to happen in 2018. Single-family rental would have been on a short list of sectors that we're backing up the truck on. We would have been wrong. We can get into this, but we are constructive heading into next year, which we'll talk about on this space. But that was the biggest surprise, and what's driven that is largely on the expense side. Revenue is stable, but the expense growth entered a sea change in 2018 where the REITs were printing literally no expense growth the last 3 years, and now it's normalizing to high 5% in 2018, which spooked the pools of capital, at least in the public markets in 2018. And we'll see where we go from here.
Good morning. As you probably remember, my name is Jeff Klein with SVN SFR of Advisors. Thanks again for for attending, and you had a great question, Greg. We've seen really 3 pretty exciting trends or shifts in the market during 2018, which we expect to continue for 2019. First is there just seems to be a huge mass of commercial real estate investors coming into the SFR space, and specifically the BFR built for rent space. So that's something that has been out there for many years, but it seems to be really accelerating over the course of the last really year to 18 months. We're obviously the 5th largest commercial real estate brokerage in the nation, so it's something that we're tracking and seeing and operating on a day in, day out basis with the commercial space investors. Secondly, as everybody in this room is certainly aware, is we've certainly seen a trend over the last 2 years, and specifically in 2018, portfolio transactions versus one-off transactions. Even smaller portfolios, where it might be 5 or 10 or 25 homes for the mom and pop and mid-scale investors, all the way up to obviously the private capital groups and large REITs. So it seems to be larger scale transaction amounts, typically on an average basis. And then thirdly, and is super exciting, is really the move with most sophisticated investors as well as mid-scale investors into clean and verified data, which is kind of the next gen for data research. And then the next gen after that, we've started to see AI, artificial intelligence, start to come into the picture from a data and research standpoint, just really over the course of the last year. And typically that's with the more sophisticated excuse me, REITs and private capital groups. So there's a lot happening on the data side. Thank you, Greg.
Thank you.
Hi, everybody. My name is Dana Sprong. I'm the co-founder and managing partner of Vinebrook Homes. We're an investor and operator in the single-family rental space. We began in early 2008. A little luckier than we were smart to time things up when inventory began to become available. We're focused on workforce housing in the Midwest. Before I talk about kind of what was exciting and interesting in 2018, when we began purchasing single-family rental homes, SFR wasn't a phrase that was used. It hadn't been invented yet. And we were unable to acquire debt. We were going to lenders with houses that we had bought and stabilized, presenting them with how we were performing, and they were not interested in touching what we were doing because they were ultimately trying to get it off the balance sheet. The transformation over the last decade, particularly the last 2 years, in the capital markets and in the interest in debt in space has been extremely transformative. For Vinebrook specifically, the introduction of the GSEs was the biggest game changer for us in 2018. We ultimately were able to recapitalize our business with new equity and debt and lower our cost of capital and end up in a significantly more efficient space by retiring debt, consolidating multiple funds that we had raised over the last decade into a single private REIT, and put ourselves in position to more efficiently run our business going forward.
Cool, thank you. And so for me, if you look at IMN through the years, and these moments in time that you get to see the benchmarks of the industry in previous years, they were usually centered around the largest owner-operators. So when the largest owner-operators first hit the scene, then there was the years when they were going public, then in the last couple of years it was the consolidation, major players consolidating. What we always thought would start taking place, and it began to really show up in a big way in 2018, was the consolidation of businesses in SFR. So those of us that were out there building businesses to serve this trend, looking around and seeing, like for example, Roofstock buying Street Lane, so a marketplace platform buying a property management company this summer. Amherst, who started out as a major owner-operator, who then did some really interesting things along the way, did something really interesting, launching Bungalow, which is an iBuyer platform. And then this morning, we just announced that Renters Warehouse, the leading property management company in the space, just acquired Own America. So Own America marketplace platform is now fused with a national property management company, and our mission is to try to, we basically woke up one day and said, hey, we're a puzzle piece. We're not the whole solution here, we're just one piece of the puzzle. We need to find another puzzle piece and plug in And so what it's doing for us is giving us massive capabilities to serve people from the very beginning of the process all the way through maybe the 25 or 30-year process from planning, acquiring, executing, owning, operating, and then eventually liquidating. I think we're going to see a lot more of that as companies begin to realize that if you're only one piece, you're deficient and you're vulnerable, and so go find somebody to link up with and put a more total solution out there. One of the things that came out from a couple of different panelists was the idea that another area of crossover that's becoming really evident is how multifamily and commercial real estate has kind of swerved out of their lane and into ours, which wasn't altogether unpredictable, right? It's a real estate asset class. And I remember, gosh, it must be 6, 7 years ago, I saw Sam Zell, a titan of commercial real estate at a conference in New York, say, SFR is impossible. Like, it's impossible. You just can't manage all these different scatter site properties. It's never going to happen. And I always think it's great when somebody says impossible, because I know what that does to entrepreneurs, right? Show them, try to prove it. So now that it's had the light of day on it for a few years and the microscope of Wall Street, and now we understand how it operates, it's now getting embraced. Anybody want to weigh in on what you're seeing? We have a commercial real estate network, we've got lenders. Like, the thing that was really striking in May at IMN, for example, was that all of a sudden a whole bunch of multifamily lenders showed up on the sponsor board. I don't know if anybody noticed that, but all of a sudden there were 5 or 6 different lenders that had never been here before that were all of a sudden sponsoring IMN and dig into their background, and they were really prominent multifamily, Freddie Mac multifamily lenders that all of a sudden were showing up here. And then they kind of disappeared most of them as quick as they got.
I realized how hard it was.
Could you just expand on that, anybody, on kind of any specifics of what you're seeing, or the person crossing in?
I'll go first this time, and then I'll go after you.
Sure. Look, from the beginning, entrepreneurs don't sit around like the banks do or like the government does and say, oh, that's a 4-unit, so it's residential, and this is a 5-unit, so it's multifamily. There is no entrepreneur who invests in real estate who thinks that way. And so the fact that the debt markets and all the other markets were set up that way it doesn't really matter to the people who are actually the users. And so from the very beginning, when we started looking at different portfolios, we always saw a mixed bag of kind of freestanding SFR, townhomes, duplexes, a 6-plex, a 5-plex, right? And we never, because we're not constrained, we're a private lender, we don't have to put it in bucket A or bucket B. But absolutely what Greg is saying, over the past year or so, there have been more and more people looking for what you think of as more commercial debt. Not because the multifamily market's not on fire. You can get much cheaper agency financing on a stabilized multifamily house. That is not the trend. But it's actually really hard to find transitional lending, bridge lending, for somebody who wants to reposition an asset or stabilize it, especially if it's kind of small, because these big multifamily lenders aren't getting out of bed for the $1.5 million loan that it takes to reposition that asset. And so I think all of us that have been serving this market have seen a huge surge in that this year. I mean, 40% of our bridge book is now technically multifamily, even though we really don't even try to characterize it, because we think of it as real estate investors managing the portfolio that is either super regional or whatever it is that their strategy is. And their strategy hardly ever follows the little buckets that the banks have put in place for regulatory capital.
And Beth is spot on, right? I mean, as you guys hear this, we got 34 minutes left and counting. If it's a basketball game, it's a long time, but on this panel, it's not. Here's what you need to know, right? Someone like Beth came from a large institutional financial background. I came from a legal background. Prior to 08, the capital markets dictated how lending trickled down into the mom and pops and small developers, period. Everything was done top down. Now everything is done virtually in absolute reverse. So what's really exciting for all of you, other than potentially some bankers in here, is you guys become the market makers. Those of us, like Beth and I, have a very complicated sort of day-to-day pattern where we have to match sort of large institutional capital with very small capital. And really what we're always trying to do, to the point Greg is making, is we're not really worried about how the market is going to perceive something. All we want to do is what's most efficient and best to develop more financial products in and around housing in America. So as Beth's talking to you about, she said it really well just now, which is we rarely have a customer who comes to us on a day-to-day basis and says, I only do 1 to 4, this is all I'm ever going to do, let's create a product for just this. We have people who come to us every day and say, we just found another niche. We've developed 12 buildings in Brooklyn in the last 18 months. Now we're moving into Bronx, but it's different because now we have mixed use, buildings that are older, different zoning issues, different permitting issue. How can you help us? And then our jobs are to like start whiteboarding how that works. So I think really what is sort of pivoting in this industry now is the fact that those of us who are in either development space, the operating space like Greg, or the financial spaces, we get to call the shots a lot more about what's going to happen, because the one thing you'll know going into this year, no matter what's still, regardless of how much rates rise, is there is a dearth of yielding products institutionally in the marketplace. That means every day when every asset sort of manager in the credit side of the US wakes up, they have to find products to invest in. And that gives all of you and us up here a lot of opportunity to figure out what those products are. And if the product is not just 1 to 4, and it's not just multifamily, and it's not just mixed use, but it's all of those things in one deal, well, so be it. And that's really, I think, the shift that's taking place.
Anybody else want to comment on the commercial crossover?
I think one thing that's worth mentioning is, you mentioned it earlier, Greg, we're in an untapped, virtually untapped marketplace in terms of 2% institutional ownership of single-family rental houses. I've talked to a number of folks in multifamily that have said when we poll our residents about where they're going when they move out, they say they're going to a single-family rental house. And that ultimately is something that they're trying to explore. Is there a way that we can diversify into the space, whether it's from a lending front or from an investment front, to participate in the life cycle of our residents' experience and ultimately get into the game?
That's a great point. We've actually seen that too. A company that has a couple of thousand units in Tampa of multifamily, and they talk about the biggest issue, one of the biggest issues they face is attrition. They've got people that move out not because they didn't love the apartment, not because of, the management wasn't good, no reason except for the fact that they had a kid. So that's it, and they need a house. And so buying a few hundred SFR in the same market allows them to not hang on to that person for 18 months or 2 years, but maybe for 6 or 7 years. And anybody who operates SFR knows that that's the game. If you can keep these places occupied with no turnover or very little turnover, you win. And so that we're seeing more and more multifamily players that we start to meet who, just like a few years ago, people said you can't operate single family until people did. And like virtually everybody who tried succeeded. It was ugly and bumpy and hard, but everybody who tried to operate big SFR portfolios pretty much got it done. They're just now beginning to discover the benefits of what makes SFR totally different than multifamily, i.e. every unit has got 2 uses. It could be owner occupied, it could be tenant occupied. And so no matter which way the economy blows, you may have a benefit coming your way. The market's good, HPA, you win on HPA. Market's bad, housing or home ownership declines, so rentership increases and you win on yield. And we're starting to see people prune their portfolios, okay? So we're taking some profits out of California because California's been shot like a rocket, so take some of the money out, try to move that someplace else. The fact that you can actually get down to 1 door and decide that you want to sell 1 door, which you can't do in any other commercial asset class, that's a risk management feature that we're just now starting to get to see people use that as a way to strategically move around and tactically move around their portfolio, change their mind on things they wish they hadn't done, double down on things they were happy they did, and that makes it really unique. I think over the next couple of years there's going to be there are going to be people who succeed and win because they learn that game better than anybody else.
Greg, I just saw some data recently that has been really hard to come at since we started in this market, showing over time the single family rents versus the multifamily rents versus HPA. And it went back kind of the last 3 recessions. And it was kind of intuitive for me, but was really eye-opening. And I think why you're also seeing people moving from the multi into the single family is that the delta in the rents for single family homes never quite moves as much as anything else, and is always positive to the yield curve. When you look at multifamily, it's pretty good, It's pretty stable. It doesn't move anywhere near as much as HPA moves. HPA, you have these huge swings, right? I mean, you could have a 40% decline in HPA in a market. You're never going to see a 40% decline in the multifamily rent, and you're going to see even less of one in the single family. And so when you actually see this chart over several decades, you realize just how stable the yield is, and how even if we start seeing some bumpy or hiccupy markets, that is what's really driving people moving into this market at such size.
Now, what do you think single-family landlords are? I mean, that's their decision making, right? They're not reducing their rents. If the economy goes one way or the other, that chart you described tends to indicate what? That they're just a little more calm and they don't run for the hills?
Look, I think it's a few things. One, your basic single-family operator is more focused on occupancy than driving rent. So they're not the airline, they're not trying to optimize each seat. I think the bigger REITs are trying to optimize now, and they should, right? They realize that they will do better if somebody moves out, but that they can actually push rents. Somebody who's running 50 homes cares a little bit more about occupancy, is not pushing rent. But I also think there's an economic piece to it where it just doesn't move as much. One of the things that surprised me early on is even around the country, your basic 3-bedroom, 2-bathroom house rent's pretty close to the same number, even though the values are so widely different. And so, maybe that's obvious to a multifamily investor because there's high cap rate environments and low cap rate environments. But when you actually see the houses next to each other and you realize that, that $1,200 rent or $1,300 rent, it only moves about $100, even though the value in the house could be moving, $100,000 or $150,000 on the post. And so it's really just a question of what people will take in yield. But the average person who rents a 3-bedroom house basically has that much capital to do so.
I think, sorry, Jeff.
I was just going to mention, Greg, it's kind of fascinating because there's a lot of conversation about the comparison with multifamily and single-family rentals. About 4 years ago, since we're a commercial brokerage, we track this pretty close, but about 4 years ago, single-family rental housing gross transaction volume on an annual basis eclipsed multifamily. Multifamily has always been the #1 investment class in commercial real estate when you compare it to industrial, office, retail centers, so on and so forth. So it's pretty fascinating. We're all right now operating in the #1 commercial real estate investment segment. So it's a legit investment class from a commercial investment standpoint.
Yeah. I think on why you've seen consistency and stability in rental rates and single-family rentals, historically there haven't been resources for landlords to understand what their market rent could be. Those resources are becoming more available to them, so we may see a little bit more variability in that. But also, the resident is sticky. It's a difficult process as a resident in a single-family rental home to relocate. You've got more square footage, you've got more stuff, you've got a garage, you've got a yard, you've got more things, you've got potentially appliances that you need to relocate, and it's a difficult process. We ultimately see the longevity inside a single-family rental significantly longer than what you see in a multifamily in terms of the duration of occupancy. So I think those two things contribute to why there's been stability.
One thing I would add, I broaden the lens a bit. I'm sure the pivot from multifamily investors into single family is still early innings, but from other commercial real estate sectors, if things play out like us and most people think they will, in shopping centers, malls, office, there's still huge pools of capital, both domestic and foreign, that are getting pumped into these more traditional property types. And now that they have a way to scale an investment in single family rental, I think that's even earlier innings. So allocations will grow, not just from multifamily, but from other more traditional asset classes, which the economics look flat out bad.
Well, that's the key, is can they scale the investment, right?
That's where people and folks in this room come in, yeah. There's only a few ways to scale that in the public markets. Hopefully that grows over time, but yes, it's still early innings of being able to put a lot of money to work at once.
Okay, so let's change gears to talking about what the topic is, economics, right? This has been an interesting year because the first quarter of 2018, the drumbeat was affordability is too low, right? I always find it fascinating how the glass is always half empty when it comes to housing in the media. You know, like if you own single family rentals and the prices are up, well then that's a good thing, but they find some aggrieved party, and this is the person who doesn't own any single family homes, and so they're aggrieved because prices are too high and affordability is low. By the second quarter, the natural progression that should happen in that situation began to happen, which is home sales began to decline, right? Like people can't afford the houses, and so they're not buying the houses, and so therefore home sales decline. So that began to talk about plummeting home sales. Unfortunately, a lot of people who read those headlines see plummeting home sales and they misread that to mean plummeting home values or something. And they try to find some downward arrow chart that they can use to try to make the impact. By the third quarter, we saw a slowdown in HPA. So price appreciation wasn't down. I mean, there were literally stories out there where they were coining new phrases about how to describe a slowdown in the rate of appreciation. So instead of being up 6.5% year over year, it was only up 5.5% year over year. So there was a 17.5% decline in home price appreciation, and the chart was doing this, right? So again, another way of spinning it as negative as possible. So now the talk is recession in 2020. That was, if you do a search for that term, recession 2020, you'll see every outlet on the planet ran a story to that effect this year. A lot of people are getting persuaded that way. In fact, our phone rang. People who said, I want to sell my 100 houses. And it was like the morning that the 2020 recession story began to hit. So, you know, people are starting to wonder, you know, have we gone through the cycle? Is it going to go the other direction? And where we are right now is they're talking about home prices, home sales, housing starts. They found each of the different parties out there in what is essentially a good housing market, each of the different parties that are somehow being harmed by what is a shifting market, maybe to a more even-handed market from a seller's market, maybe to a buyer's market, who knows. So I want to ask the panel, number one, what do you think of all that? And number two, is it affecting your plans for 2019 in terms of how you deal with, if there's a shift in the market, what do you do to, you know, to react to it?
Kick off. We don't actually own homes or, you know, invest the money, so we're kind of the armchair quarterbacks. I'm not sure how the plan would pivot from our lens, but we read the headlines, and I agree that it's just a sudden shift in the cherry pick a headline, and suddenly you can paint a different thesis. What I would say is that, well, one, we don't believe we can forecast things like interest rates or recession. So if I came out and predicted home prices, I'd probably get fired. But what I will say is I think the lack of savings for a down payment in this country is grossly underestimated. And if you don't get a ramping in mortgage lending for that 650 FICO base, there seems to be an anchor on home price appreciation, home sales. It's just that next vintage of debt-burdened customers hitting with $5,000 in their checking account and they can't even afford a home in Atlanta. I think that's underestimated, and that's not going to change overnight. I'm more worried about high-end home prices than starter home, but that's just my personal opinion. I do think the demographic story will support single-family fundamentals and home prices a bit, but it's a consumer balance sheets in this country are not good. I'll just leave it at that.
From our vantage point, I echo what he just said. We are highly cautious on the high end of the market. I think it's very difficult for most people to appreciate just the depth of wealth that's come into this country from foreign nationals around the higher end of the housing markets. I mean, technically the pricing could be regional, but nevertheless, whether it's 5 million, 10 million, or more, that is of grave concern. For us, though, I think our sort of core thesis is there and withstands recession or no recession, which is there is a housing shortage in the US. There is a firm migration back to urbanization. Most people want to live closer to where they work and the resources around that than maybe 10, 20 years ago. So I think when you're dealing with infill projects, repositioning of projects, you look at cities like Los Angeles, which effectively the whole city is green lighted for redevelopment. I think that's going to stand the test of time, whether the Fed next year, which just came out last week, to Greg's point about being sort of responsive to maybe the administration is saying now there may be only 1 or 2 more rises in rates till we get to that low end of the neutrality, what they're looking for. You know, who knows? But what we do know is the core thesis is there is a housing shortage and there is a migration towards urbanization. So the selection of which cities you are going to finance or develop in become critical, and the product becomes critical. We are definitely in a more mature end of the cycle than we used to be. And frankly, I do think that means that experience and discipline is going to win. Beth and I were talking before with all of you about 5 years ago, 6 years ago. It was a lot easier to finance virtually anything coming out of sort of effectively the worst recession at least almost a century. Now you're in an environment where there is a much more high probability of making a mistake. So really understanding what it is you're trying to do within this is critical.
Just why do you think it's the higher probability of making a mistake?
The markets are way more efficient. People are lending more money. Institutions lend us probably 15 to 20 basis points, 200 basis points more of money and rate reduction than they would have 5 years ago, 3 years ago, 2 years ago. Those banks and those asset managers are chasing firms like us because we have scale, and we're chasing the best developers because they have scale. So it starts to create a lot more efficiency in the market, which means that around the fringes, you really have to know what you're doing because that'll be the first sign when there's problems.
Look, I would echo a lot of what both of you are saying, in that there is absolutely an affordability issue in some parts of the market. But if you really look at the different cohorts, and we're so focused on the single-family rental cohort, in fact, the average house that we finance is only $150,000. That house is workforce housing, and it is absolutely in demand, and there's going to be a scarcity of it over the next decade. So I think it's actually almost a defensive move against some of the things that are happening in the broader housing market. I don't think we're going to see this across-the-board decline like we saw last time, because the demographics just don't support it. You have too much household formation over the next several years and no place to put those households. And the cohort of household formation is in the exact spot where I think that the single family rental is the most robust, right? Absolutely, people are gonna have problems moving into the next level home. The mortgage rates are going to be too high. They're not going to be able to get out of the one they have. I think even the $300,000, $400,000 price point house is going to start having problems, not just the high-end luxury. But the basic workforce housing is, I think, actually a very attractive defensive measure for the next decade.
Anybody else?
Ultimately, from is it a buyer's market or seller's market, you pretty much can look at what's happening across the country in terms of supply. And 15 of the top 30 single-family rental markets have less than 3.5 months supply available. Ultimately, getting to 6 months supply is typically where we determine if it's under 6 months supply, it's a seller's market. If it's over 6 months supply, it's a buyer's market. And based on the limited construction that's occurred, the limited construction in the sub 1,800 square foot size over the last 5 years, there's challenge on what can occur in terms of overall conversion to a buyer's market. So.
Okay, great. All right, so predictions for 2019. I know people sometimes are shy about wanting to do that in front of a live audience. That people are going to write things down and tweet them, and then you have to come back and defend them a year later and see if you were right or wrong. But don't be afraid. These guys will be gentle. It takes guts to make them. Is anybody? I asked you to think about what, it doesn't have to be anything, home prices will be X. It could just be something in the industry, something in your business. What do you think is going to be one of the more impactful things to take place in 2019?
You're the professional.
Yeah.
Not sure about that. I won't forecast interest rates or home prices. What I will say, our view is that single-family rental REITs and the asset class in general, I know a lot of folks in this room are buying physical homes and renting them out and trying to build platforms. So the economics on that side, the direct real estate investment, look pretty darn attractive these next few years, but from a public market perspective, which will ultimately help folks in this room, whether it be an exit or a path to growth, I do think single-family rental REITs will outperform the vast majority of other REIT sectors. They're dead last this year. I mean, the fact that you could have made more money in shopping malls and shopping centers versus single-family homes still floors me in 18. I do think that reverts back next year, and AMH and Invitation are one of the top 2 performing REITs in the sector, which may provide a path for a potential IPO or 2. So at least one IPO, U.S. single-family rental REIT IPO, there's a chance there.
Greg, I can make a prediction that I know is going to be 100% true. Can you believe that for 2019? What a crystal ball. We just launched yesterday at SFRhub.com a new transactional portal platform. So the one thing that we will see in 2019 from yesterday forward actually is the ability to actually transact 100% online with single-family rental investment housing. So that's something new, and it's a shift, and we're proud to be a part of that, the beginning of that shift. So I'll be pretty excited.
Congratulations.
Thank you.
What do you think?
I'll tell you, there's 2 things I love for next year. I love urban infill. There's some real obsolescence in the housing stock, and particularly in some of the urban areas that are close to jobs and are really decent rental yields. So I think you're going to see a lot of repositioning of assets that are not financially distressed, but just distressed because they're old and obsolete. I also really like build to rent if it's done correctly. I think you're going to see a little bit of shakeout. I don't think all the players are going to be quite as strong as some of the others, but there are some people that are out there doing it really well, and I think those communities are going to be very popular.
So Beth and I generally do agree on most things around this. Number one, I totally agree with what she just said on the first point. Urban infill is, I mean, all of you could spend the next 5 years of your careers redeveloping one city, let alone multiple cities. The velocity of what's happening, especially in the larger cities, is profound. I'm sure both of us can give you some data after. But that's number one. Number 2 is, you just heard it up here with Greg and others. There's going to continue to be significant consolidation in this sector from now till next year at the very least, both on the operator side, the finance side, and then the service side. That's very healthy also for all of us. As we're hearing about more public capital coming in, more eyeballs on the business, there's already an enormous amount of private capital hovering around this business sector. And as a result, generally that leads to a lot of consolidation. So whether you are the consolidate or E, I would think that having partnerships, one form or another, are critical to the scale and the complexity of what's going on. And I'll just leave you with one small tidbit we've been looking at for 2 years. For this year, something we're working on, which is really sort of quite complicated for us, which is there is an enormous amount of ERISA qualified capital on the sidelines, generally in the forms of IRAs, that are somewhat in this space, but are going to come into this space much more, especially with volatility in the stock market now. And the same goes for foreign nationals wanting to continue to own hard assets in the US.
I agree with the consolidation occurring to a further degree in 2019. I think something that's going to also occur 2019 and 2020 as we see potentially values beginning to plateau a little bit. We've seen HPA outpace wage growth. We talked about supply and the constrictions there. Ultimately, as we continue to evolve in this space in SFR, we are going to have a tempering effect on any potential slowdown in HPA because there's so much demand for the product. So I don't know if it's going to be 2019, 2020, or 2021, but I do think there's going to be a tempering effect based on, significantly from the folks in the room here today, the work that we do to invest in the space.
It's going to create the floor that people were worried about in the last one. when they were hoping that people would come in and create that floor as it was falling down. I think it's a natural floor.
I also agree with Beth in regards to the BFR built for rent segment. We literally, over the course of the last year, have had probably a half dozen private capital, public and private capital groups reach out to us, and we see the formation of probably right now, just that we're aware of at least, about $3 to $4 billion of private capital formation, specifically targeted for built for rent segment in 2019. So I think we're going to see that as home builders start to slow, as we just talked about in regards to commercial retail home buyer sales. I think it's going to be kind of a perfect storm, so to speak, for both the private capital investors in the BFR segment as well as the home builders.
Great. So we're going to segue. We have 5.5 minutes for Q&A at the end, so if anybody's got one, get ready. I don't know if we have any mics out there or not, but we do. Okay, so if you've got a question, please stand up, raise your hand, and someone will run that over to you. My quick prediction is that, this is not a prediction, this is based upon things that are happening now, that the questions we're being asked, is that there's going to be a bunch of markets that have really not been part of the top 20 SFR cities in the past that are going to begin to get activated. People are asking us, where should I go where the big guys aren't? And some of the big guys are saying, and gals are saying, where can we go that's like where we already are, that has some of the same fundamentals, that we can begin to try to get scale. So I think you're going to see some places that have not been institutional SFR markets per se are going to light up. Okay, question? We answered everything everybody had on the question. Who's got a question? You know how hard it is to save 5 minutes at the end of this?
There
you go.
David,
What's up?
Question for John. So John, so you're talking about the two big public REITs. You think they're going to do well next year. Now, I know you're not going to predict interest rates, but interest rates are going up. And, you know, as everyone probably knows, those players are buying very, very low cap rate houses. I mean, do you see them expanding their buying given that the differential between the rental yields and, you know, what I'll call super safe treasuries is going to shrink significantly, and a business model of buying houses that are sub 5, maybe even sub 4 yields, when you start looking at 2-year money that could be 3+%?
It's a good question. So right now, the answer is no. I don't anticipate the two big REITs to engage in the pie eating contest or anything close to the pie eating contest of 2012 through 2016. Given where their share prices trade today, they can't tap the common equity markets to fund that growth. There'll be modest growth, filling in of subscale markets, but there'll be some pruning too. So as of today, at current share prices, no, it'll be pretty modest positive net external growth type environment heading into next year is the base case.
Just following on from your earlier point there, if each person on the panel could mention maybe a market that isn't active or as active as it should be now that you think in 2019 would be a good market to invest in.
I didn't hear the question.
Someone repeat the question?
Sorry, Irish accent. I was just wondering if everyone on the panel could mention one market that isn't as active in the rental space you think should be next year.
So a market that is not as active in the SFR space that we think should be. Anybody want to take a crack at that? A market that's going to be up and coming?
Going to get better? I would just say Los Angeles, because it is active, but it's virtually infinite in size compared to virtually every other market. And the way the zoning works in the city of Los Angeles, there's enormous opportunity and very little friction to build rental housing.
I think we're going to see some growth in markets that haven't been top target MSAs over the course of the last few years, mainly in the Midwest. You see the St. Louis, the Kansas Cities, Oklahoma City, Des Moines, Minneapolis, and some of that Midwestern score seems to be a target for a lot of new investors as well as a lot of existing investors.
If I was buying physical homes. I wouldn't necessarily be scared away by very low cap rates in Southern and Northern California, or even a market like Seattle. I think outsized near and long-term growth can really bail out those low starting yields and make a long-term IRR look more attractive than a lot of other markets through a full cycle. Seattle's an up-and-coming market that we're pretty bullish on from a single-family rental front right now.
Personally, I like some of the secondary Northeast cities. Things like New Haven, Providence, Rhode Island. Really love Portland, Maine. Places where I think there's decent jobs and people want to rent houses, but it's not kind of overrun with people yet.
So we're just scratching the surface. Ultimately, we've heard talk in 2018 of kind of migration into the center of the country. But as Beth just alluded to, there's markets across the country that have opportunity.
And what we're seeing is the hot SFR markets, Dallas, Nashville, Atlanta, Charlotte. People are asking, find me something that's lagging 10 years behind those markets that has some of the same inbound migration, same job fundamentals. So we like places like Huntsville, Alabama, Chattanooga, Tennessee, that's the new Nashville, Columbia, South Carolina. So places that are within striking distance of some of those larger markets, that some of the operational infrastructure can be borrowed and sort of tagged onto from some of the larger players. They're sharing some of those fundamentals, but they haven't gotten crowded yet. Look at that, 9 seconds left. All right, I think that's it. Thank you very much. Appreciate your time.